Hello guys, how are all of you doing? My name is Sanjay Sagar. I'm the Financial Management Specialist for Phoenix Financial Training, and I'm just going to do a small talk today about working capital management. Now, from an exam point of view, working capital management is a core topic, does regularly get tested as a Section C question. Every sitting it features. Some of the other topics within working capital management does come in both as MCQs in Section A or B and as a Section C question also. Now, I'll do a little bit of talking in terms of knowledge about working capital management, and also a little bit about what are the core areas, what are the more important areas that the examiner likes to test. Now, he likes to do, from a theory point of view, what he likes to test is a little bit of the core important thing within working capital management that he wants you to know is the compromise between profitability and liquidity. Now, you cannot have both. You need to have, a company can have a strategy where it's aggressive and prioritizes profitability, sacrificing liquidity, or could be the opposite, where it goes for a conservative strategy where it wants to prioritize liquidity but sacrifices profitability. Now, the examiner likes to do a little bit about overtrading also, in terms of what happens when a company becomes over aggressive, when it's just searching for profitability, does not really care about liquidity. What are the risks with that? What are the symptoms of overtrading? You have to do something like a ratio analysis there and decide if the company is trading too much, relying too much on short-term finance, not really looking for long-term sources of finance, and so on. Now, other than overtrading, he likes to look at each component of working capital. So the examiner likes to test inventory. And in inventory, what he likes to do is he likes to get the student to check whether the student knows whether you should hold a lot of inventory or very little inventory. And the answer to that question is, again, you need a balance. You don't want to hold too much stock in your warehouse, because then you end up paying a lot of storage costs, holding costs. There's a risk that inventory can become obsolete also. Whereas if you hold very little inventory, you run the risk of running out of inventory, which again might affect your reputation. So we need to try to find the balance. And how do we find the balance? By using a simple model called the EOQ model, which is the economic order quantity. Now, the formula for this is given in the formula sheet. All you need to know is what the variables stand for: CO, the cost of ordering; D, the demand in a year; CH, the cost of holding a unit for the entire year. Take a square root of all of this and get the optimum quantity to be ordered. Now, what a lot of students often do is they know how to compute the EOQ, but they do not realize the meaning of the EOQ. Now, the EOQ is the optimum quantity to order at a time, not what we have to hold in the store. So what the amount of units that we hold in our store is the reorder level, which is not the same as the EOQ. So he often likes to test the meaning of the economic order quantity also. He likes to do questions based on this, where he puts in a discount that the supplier is offering, and then make you calculate the annual holding cost in a year, the annual ordering cost in a year, look at whether it's going to be cheaper to take the discount or maintain our current ordering policy. So do a computation of annual holding, ordering and purchase costs under the old scenario, as in the current ordering quantity, and the new quantity which the supplier is ready to give a discount for. That's inventory. Then he likes to test other components also, like receivables, and within receivables what he likes to test is two main things. One is in terms of factoring. Now, what is factoring? Factoring is just outsourcing your receivables, getting a third party to go administer the receivables, do the collection, follow up, monitoring, all of those, which means less hassle for the company. He likes to do this both in terms of theory and in terms of numerical questions also, where he says, do you think it's going to be financially beneficial to outsource our receivables management to a third party? Now, that's one important topic within receivables. He also likes to test the other topic, which is giving an early settlement discount to our customers. And the idea behind this is, if we offer an early settlement discount to customers, we can get them to pay earlier. We can get our money faster, and we can use this money then to either repay our loans, saving interest for the company, or fund our business to maybe expand our cycle, produce more, and expand the business. So he likes to get you to do a computation saying, should we offer a discount? What is the maximum discount we can offer? How long do we need to offer a discount for? Do they need to pay early, let's say 10 days, 20 days, what the difference should be compared to the current receivable days. Something similar, what he likes to do is in payables also, which is pretty much the opposite. If you know what to do in receivables, you also know what to do in payables. And the last model that you have is cash management, within which you have two models, the Baumol model and the Miller model. Both the formulas are given to you in the formula sheet. Generally, there's nothing too difficult there. All you need to know is how to apply the formula within the exam with the numbers given. Thank you guys. I hope you've got a decent idea about what working capital management is about and what to concentrate on in the exam in terms of what gets often frequently tested. Thank you.